So, in this video, I want to talk about a stock that met my criteria. However, the market did not confirm my opinion. And this is very important for you to understand. When you look at a stock, if it looks very good technically and fundamentally, and you identify a proper buy point, that buy point or that yellow line, it represents your opinion. It is not a fact. You are the one who thinks that the price will break out of that buy point. However, sometimes what happens is the market does not confirm your opinion. The price never reaches the yellow line, or in fact, the price starts to fall down. So, we will look at an example of such a stock. So, the name of the stock is Ajanta Pharma. Let me open that stock for you. So, let's go to Ajanta, this one. So, have a look at this base. And I was looking at this stock on this at the close of this day, at the close of 11th of October. So let me show you that. Yeah. So this is what I saw on the close of 11th of October. As you can see, tight price action. The price is above the 50-day simple moving average. The 50-day is above the 150-day, and the 150-day is above the 200-day simple moving average. So it is a strong stage two uptrending stock. That's number one. Number two, this is point one in the base, the top highest point in the base. After point one, if you start counting, there are more than 10 candles in the base, which is our basic criteria. Then, if you count the number of points in the base, for which I have made a separate video, you can watch it. I will place a link somewhere here. So, 1, 2, 3, 4, and 5. So, there are 5 points in the base. Our minimum requirement is 4 points. So this stock is meeting all our technical criteria. It is a strong stage two uptrending stock which is forming a base, and now it has formed a buy point, and it is showing a tight price action on the right side. So if you convert this to a bar chart, see there are tight closings. Okay, this is very important. Moreover, the buy price, the yellow line, is in the green zone. The green zone is the top quarter of the base, which is even better. Okay. So, and this is a mother baby candle. So this is called as an inside bar. The high and low of this candle is inside the high and low of this previous candle. So that's called a mother baby candle combination, or that's called an inside bar in Western technical analysis. So whenever you see an inside bar, it is highly likely that the price will either break out on the upside or the downside. Inside bar or a mother baby candle does not mean that the price will go up. It simply means that the price is likely to break out. Now, it could be an upside breakout, it could be a downside breakout. We don't know. We have to wait. Now, this yellow line that you see, as I said earlier, the yellow line represents your opinion based on all your technical and fundamental analysis. You have decided that the yellow line is the right price at which we should buy the stock. That's your opinion. Okay. If you read Jesse Livermore's book, How to Trade Stocks, which was written in 1937, in that book, if you read the first chapter carefully, the moral of the story of that first chapter is that yellow line which you see on the chart, it represents your opinion. Okay. Now, unless the market confirms your opinion, you are not supposed to buy the stock. That is what he was trying to convey in that first chapter. Jesse Livermore, as you know, he was a legendary trader in the early part of the 20th century. So around 20s or before even 1920, he was trading the stock market, and at one point in time, he was the richest man in the world. Okay, just a stock trader. But in the end, there was some tragedy in his life, and he ended up committing uh, suicide and things like that. So, a lot of things happened in his life, but he was a pioneer in the field of stock trading. He laid out certain fundamental timeless principles, and this is one of them. Unless the market confirms your opinion, do not buy the stock. Okay. Now, this is all technicals. Okay. Everything looks fine here. You have high volume rally, you have low volume consolidation. Now you're expecting a high volume breakout. Okay. That's the step number 3. Let's look at Market Smith data. Why did the stock come on my radar in the first place? So let's go to Ajanta Pharma. So we have to see some parameters related to the stock. Wait, I think I'll have to log in. I have the pro version of MarketSmith because I want to save time. And in India, it is not very expensive. So Ajanta Pharma. So let me open this. So let's have a look at this data. I click on consolidated. Okay. It's a fairly large company. 40,000 crore means 40,000 multiplied by 10 to the power 7. Okay. It's a large company. It's a huge company. If I click here, as you can see, it says pattern flat base stage is 3. So we are buying the stock at base number 3. So we are buying it middle stage. Okay. Now have a look at this double digit quarterly growth in EPS, double digit quarterly growth in the sales. So fundamentally, it looks good. Recently, the growth rate has declined, but growth is there. Okay. Fundamentally, stock looks good. The number of funds that are holding on to the stock has increased from September quarter to the June quarter. Management owns more than 50%. These are all positive factors. Okay. The up down volume ratio is 1.4, which is very good because up down volume ratio basically is the volume in the stock when the price is going up divided by the volume in the stock when the price is going down. Okay. If that number is more than 1, that means there is more push on the upside. It indicates institutional buying. Okay. And that is confirmed by this rating, which is A plus. So A plus represents institutional demand. Master score is above 60, which is very good. EPS rating is above 80, fantastic. Price strength is questionable. Okay. 79, but that's fine. Anything above 70, we can consider the stock provided all other factors are in our favor. Group rank is within 40, below 40, which is very good. It's an outperforming industry, pharma industry. Okay. Generic drugs, medical. EPS growth rate 14%. Okay. Earning stability. The smaller this number, the better. PE ratio is at the higher end of the 5-year PE range, which is fantastic. Return on equity is more than 17%, very good. Cash flow from operations per share is positive, which is very good. In 2017, the earnings per share was 38 rupees. Now it is 64.8 rupees. It's expected to go to 74 rupees. So that's a steady increase in the earnings per share. So if you look at all of this data, one glance at these parameters tells you that it is a fundamentally strong stock. So this is a stock which is showing technical as well as fundamental strength, except for the price strength. Now, on this day, the price strength was higher than 80. This price strength is as of the close of the current day, but we are looking at the stock somewhere here, not here. So both these numbers were above 80 when I was looking at the stock. So see, the stock looks fundamentally and technically strong. So now that because of that, our buy price becomes this. So you expect the market to confirm your opinion. Okay. The reason why I call it an opinion because that's what it is. You think that the price will go up, but does the market think that way? That is what we need to find out. So assume that there are 10 million participants in the market and you are one of them. So the remaining 9.999 million people collectively, if they know more about the company than what you know about the company, then we have to respect their opinion, not your opinion. Okay. The opinion of 9.999 million people is more valuable than your opinion. Okay. And if 9.999 million people think that the stock should go down it is going to go down. They don't care what you think, or they don't care about your opinion. So that is why we have to wait. We put the mobile alert near this price, and then we wait. And look what happens the next day. See, this is a fact. The price went down by 2.62% on 14th of October on low volume. That's a fact. This candle does not represent opinion. It represents fact. Now, what does that fact do? Does it confirm our opinion or does it negate our opinion? Obviously, it negates our opinion. Look at the next candle. Okay. Not coming close to our. Now it has started coming close to our yellow line. So the market is trying to come to our buy price and see what happens. See, again, it comes down. So overall, if you see, this is the current candle. The close of this candle is 3199.55 and the blue line is 3201.48. So which means the stock has closed below the 50-day simple moving average, which is not good for any stock. Any stock which is below the blue line is not a stage 2 uptrending stock. So now the stock has lost its stage 2 status. Okay, extremely important point. And if the stock has lost its stage 2 status, we are not interested in the stock. Remember, for stage 2, price has to be above the 50-day. The 50-day simple moving average has to be above the 150-day, and the 150-day should be above the 200-day. That's the basic criteria that you have to follow. And why do you have to follow the criteria? Because Mark Minervini, who is a two-time US investing champion, in his research, he has found that the growth stocks of the past century, if you do analysis, he found that 96% of all the growth stocks of the past were already in a stage 2 uptrend before they began their full scale advance. So this stage 2 definition is supported with facts. This is called as reverse factor modeling. Okay, where you look at growth stocks and just before they started their advance or just before they started their huge rally, you try to find out some common characteristics in all of these growth stocks. And when you see such characteristics appear in stocks as you analyze the stock market daily, you will have confidence to take the trade. So this is a trade that I never took. So it's very important that I discuss these things with you, because as I have been continuously telling you that your trading performance is more a function of how many stocks you reject as opposed to a function of how many stocks you select. So your ability to reject stocks is more important than your ability to select stocks. If the price is not coming near the yellow line, and before even coming to the yellow line, if it breaks the 50-day simple moving average or the blue line, that's a disaster. This stock is probably headed for disaster unless something good happens on Monday. Okay, anything that breaks below the 50-day simple moving average has gone into danger zone. Okay, one good thing is that the volume is low, so it might bounce back, but we are not interested. There are thousands of other stocks in the stock market. Let us focus on that. So the moral of this video is, unless the market confirms your opinion, don't take any action. Okay, be ready to take action, but don't take an action unless it is confirmed by the market. Okay, so I hope this video has added value to your overall trading journey. During my explanation, if you feel that I was not able to explain something properly, please mention that in the comment section so that I can improve on my presentation skills. Plus, please support this YouTube channel. Please like, comment, and share this video. That will allow this video to reach those people who genuinely want to become professional stock traders. Okay. Thank you so much for your time. Thank you so much for your support towards this YouTube channel. Thank you so much. I will see you in the next video.